It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to Your Personal Bank Show. And I'll tell you what, I don't know about you, but I'm a little tired of talking about coronavirus. I'm sure, as you know, in the last couple of months, actually since the beginning of March, we've been talking about coronavirus and how it affects your money. And certainly, I'm just going to say this, and I want to cover some other things. I want to cover some opportunities that have presented themselves. But all I want to say is there's some reasons for optimism, with states opening up and those kinds of different things. There's also reason for caution because of the uncertainty that's out there. So any number of scenarios could happen. So I'm going to say proceed with a cautious optimism. So, keep that in mind. But what I really want to talk about, like I said today, is this. There's some real opportunities that have presented themselves. And a lot of those revolve around the CARES Act, which was passed by Congress as a stimulus for the COVID, of course. And some of the opportunities that presented themselves that we can take advantage of with our money right now. Many people there's a lot of provisions with the CARES Act. We've talked about this also on the air about the business loan provisions, and they're changing them and relaxing some of the restrictions, thankfully, to allow more businesses to qualify. There's a lot of changes with IRAs, distributions. You can access monies from an IRAs today for reasons of loss of income and various things due to COVID. You can access more of your money from your 401k a lot of the times. Not all plans allow it, but they've relaxed the restrictions. They've relaxed a lot of the penalties, like the tax penalty for under 59.5 has been waived for this year for COVID reasons. So if you've got those kinds of situations, I'm going to really encourage you to talk to us at yourpersonalbank.com. We can share with you the parameters, what you can do, what access you can have. They pretty much laid down the rules on that so you can access funds, or, what the payback provisions are and various things. But another little known thing that has occurred due to the CARES Act, it actually impacts stretch IRAs. Now, those of you that don't know, stretch IRAs are a provision in the IRA tax code that allowed folks to, in essence, pass on an IRA to the next generation and mitigate the tax consequences, spread it out over time, in other words. Well, the stretch IRA provision has basically been eliminated due to the CARES Act. And so there's a lot of changes for the folks that have done any sophisticated estate planning, have done tax planning, or just have an IRA and have some concerns about what to do with that, how to best get it to the next generation, okay? These are questions that have been answered by, CPAs, financial advisors. There's been a way to go about these things for quite some time, and pretty much all that's turned on its head now. And I've got an article here. We're going to post it on the yourpersonalbank.com website. But the title of the article, it's from Financial Planning, is Why Life Insurance is the New Stretch IRA. Now, before you say, insurance again, well, here's the thing. I want you to point out something. Who wrote this article? Ed Slott. Who is Ed Slott? Of course, Ed Slott is a CPA. But more than that, Ed Slott is probably one of the best recognized IRA experts in the country. In fact, the Wall Street Journal quoted him as the best source of IRA advice. I've heard Ed speak a couple of times. He's very knowledgeable. He is recognized as one of the top, or I should say one of the leading IRA experts in the country. He's a former past chairman of the New York State Society of CPAs, for example. He's written several books. He has a CPA firm. He's not a financial advisor. He's a CPA. He's a tax person. And again, I frankly probably could not give you a better source than Ed Slott in terms of IRA advice. So when Ed says something, it carries some weight. So I want you to understand, I'm only bringing this up because, again, if you've listened to the show, you've heard me talk about this before, where some people, they miss the whole point and they hear life insurance and they just turn off. And, it's regrettable many times because they don't realize that some of the things that they can do, the financial tool can do. It's no different than saying to a carpenter a hammer is bad or a saw is bad, okay? It's a tool, okay? It's agnostic. It's designed to do a specific job. And, of course, a hammer's great at hammering nails and a saw is great at cutting wood, but they're not good at doing the opposite, are they? So, again, when you hear somebody say this insurance is bad or annuities are bad or some other financial product is bad, remember, they're just sharing their personal bias. And one of my pet peeves in the industry is, hey, when I talk to advisors all the time, I say, look, it's not about you and what you prefer. It's about the client, okay? That's the key, all right? What's the best fit for the client? So again, when Ed Slott, one of the top CPAs, one of the top in the country, one of the top IRA advisors in the country says, hey, this is the new Stretch IRA, it's worth taking a look and considering this and looking into it further. And he goes on and he talks about how the clients that are most affected by the Secure Act in his article are ones with some of the largest IRA balances. Now, he also goes on and says later, even those with smaller IRAs can definitely benefit, okay? But like I said, many of these clients name trusts as their IRA beneficiary. So if you've set up a trust as your IRA beneficiary, it's time to reconsider your plan. Like I said, most of these plans will not accomplish the desired result without a prohibitive tax cost. And again, it's IRAs. Like I said, IRAs are no longer a good vehicle for estate plan, but insurance vehicles with some caveats are. It's changed. The situation, the CARES Act has changed what's going on and how to deal with estate planning and taxes with IRAs, particularly passing on to the next generation. Now, I like this. He also points out, he says, look, I'm referring only to permanent, that is whole life insurance with cash value, not term, because again, the plan must hold up long term. So here's one of the top CPAs in the country, one of the top IRA experts in the country saying, look, this is the tool you really want to take a look at, okay? Like you said, to keep your client's IRA estate plan intact, the IRA portion will probably have to be replaced. Now, he talks about two options, two tools. Either a Roth IRA versus, via lifetime Roth conversions or with a life policy. And he goes on and says it offers better leverage and flexibility since it won't be subject to any post-death Secure Act limitations. So getting a little technical here for a minute, but the point is the purpose of a Stretch IRA, again, if you've set one up or considering setting one up, you want to reconsider that now because of the CARES Act. And it won't accomplish most likely what you want it to accomplish, and setting up a trust as a beneficiary of our IRA and those kinds of things doesn't work like it used to anymore. And again, if you've done that or considered doing that, contact us at yourpersonalbank.com. We're very familiar with these tax laws and these rules and how to structure these so it will accomplish what you want it to accomplish, okay? Now, we're going to go into more detail about this and how this is going to affect folks. Well, again, folks, anyone pretty much with an IRA, how this can affect them and impact them and work out better to accomplish their goals that you wanted to accomplish. So like I said, one of the things that the CARES Act has done is provided it's caused a change, and in change, often there is opportunity. And it's created a change in how you want to plan. How do you want to structure your IRA? How do you want to pass it on to the next generation? And how the taxes are going to impact all of that has all changed. So now's the time to take a look at this and consider how this is going to impact you and how your former plan may not work like you want it, like you intend it to, and you need to change your plan. Now's the time to look at it. So stay tuned in the next segment. We're going to go into this in more detail to share with you some of the things that you need to do with your plan to minimize the taxes and make it the most efficient to the next generation.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking today about Stretch IRAs. And why are we talking about that? Well, the CARES Act has created an opportunity. Well, actually, it's changed. It's eliminated Stretch IRAs, basically. And they don't operate the way they used to. And so, like Ed Slott, one of the top CPAs and IRA advisors in the country, he wrote an article called Why life insurance is the new stretch IRA. We're going to post this on yourpersonalbank.com. And again, I'm going to encourage you to check this out because like Ed says, he's a CPA, one of the top advisors in the country. He teaches this around the country. I've heard Ed Slott speak more than once. He's written several books. He's the former chair of the New York CPA board. I mean, I almost can't get you a better source. And like he said, he talks about that most of these plans that were designed previously won't accomplish the desired result without a prohibitive tax cost. I mean, the reality is IRAs, as traditional, and we're talking about traditional IRAs, and this is something I run into quite often, frequently, is it's surprising. I was talking to somebody just the other day, how little is really understood by many people the tax impact of IRAs. You know, this person I was talking to actually was surprised that they were going to have to pay taxes when the money came out. And this was on a traditional IRA, you know, when they were a certain age. You know, those things happen. And here's the thing about IRAs. When you're contributing to them, you know, you've got to consider, you know, a traditional IRA versus a Roth. Okay, they work differently. A traditional IRA 401k is pre-tax dollars. Pre-tax dollars means you haven't paid any taxes on that money going in. Therefore, you're going to pay the tax on the way out. Now, if the goal is to grow the money over time, obviously, build that nest egg. The thing is, one thing you have to consider, and a lot of people don't, is how much is the tax impact going to be on that account on the way out, in retirement particularly. You know, if you do it like planned, you're deferring tax on the small amount of money, and if it grows over time, you're now taking out on a much larger pile of money. In our industry, a lot of people refer that to as a ticking tax time bomb. Now, it may or may not make sense for you to do that, to contribute to that IRA or 401k. I'm not sitting here telling you should or shouldn't. What I'm telling you is you want to consider all the ramifications. In other words, don't just put your money into your 401k or IRA because everybody else does it. Understand what the tax consequence is. Is it better to pay tax on a smaller amount of money now up front, like in a Roth situation or an insurance situation works like that? Or is it better to grow it tax deferred and pay the tax on the way out? That's your difference of your traditional versus your Roth, if you will. Okay? So looking at it and understanding the ramifications is key here. And understand, often I run into people who didn't realize the impact of the taxes later, and they created this tax time bomb, as we call it, and now they want us to defuse the bomb, overnight. And as I point out to people all the time, look, you built this bomb over years and decades even. You don't defuse a bomb overnight. You do it carefully and strategically, okay? The CARES Act has created some opportunities in that respect with COVID. There's some parameters to it, but there's some opportunities that were available now in 2020 that weren't available previously. For example, the 10% penalty tax has been waived, I think, for withdrawals through, September sometime this year. So these are things to consider and look at if your situation is appropriate for that, of course. Let's look at that and let's consider it and see if it makes sense. Roths are often popular because they work the opposite. In other words, you're paying tax on a small amount of money, the seed, and then letting it grow tax-free and taking it out in retirement or later, which is a harvest, which hopefully is a much bigger amount of money, right? And that's why a lot of people do Roth conversions and those kinds of things, because they want the money to grow tax-free, basically, and access it in the future without tax. Well, what does that do? One of the things it does is it takes away the uncertainty of future tax rates. There's lots of arguments today about, what are tax rates going to be, and with the government, printing all the money that they have and all these kinds of things, what's our tax rates going to be in the future? Here's the thing, nobody knows. It's an unknown. It's uncertain. And if you're paying tax at an unknown future rate, you've created another level of uncertainty that a lot of people want to take off the table. Just like if they want to take off market risks off the table, they look to investment financial tools that have guarantees. We talk a lot about that with the personal bank and annuities and other tools like that take a lot of that financial risk, the market risk, off the table. Puts floors, guarantees in place, right? By paying the tax on the money going in, so you would do that post-tax dollars with a Roth or with a life insurance contract, for example, you take away that tax uncertainty for the future, don't you? Because now you can have an income tax-free kind of situation. Now, like I said, I'm being general here. Everybody's situation is different. Please understand. And we can talk to you about specifically in your case how that can work. But like Ed Slott is talking about, I kind of got off track here a little bit on this article, is like he's pointing out, many of these traditional IRA-type plans that were structured to, minimize the tax impact for the next generation just won't work like they want them to without a prohibitive tax cost, like he said, with these stretch IRA type plans. So, and he even said the tool, you got to use a permanent life insurance tool. Whole life is what he recommends actually, because it's got to hold up long term, right? He said, look, to keep your client's IRA estate plan intact, the IRA portion will probably have to be replaced with either a Roth IRA, that's what I was starting to refer to, with lifetime Roth conversions, or with a life insurance, okay? And he even says right immediately thereafter, says, look, the insurance offers better leverage and flexibility because it won't be subject to post-Secure Act limitations, okay? He's talking about future tax rule changes, right? He says insurance offers more post-death control and less tax. And by drawing down the taxable IRA balance, taking advantage of today's lower tax rates, this is what I was talking about briefly before, it's only scheduled to remain in place until 2026. So the current tax law we're under right now, and we are on rather low, like you said, lower tax rates historically, this is in place. This is the law in place until 2026. What's going to happen at that point? Again, no one can predict, the political or tax implications, in 2027 right now. It's impossible to predict. And so, like he says, IRAs are no longer a good vehicle for an estate plan, but life insurance vehicles with some caveats are. So again, if you've set up something with your IRA as a distribution to your heirs, or you have some distribution planning, estate planning, things in place, trusts and whatever else, it's time to relook at that. Because again, like Ed is saying, it's probably not going to work like you intended, okay? And here's the other thing. By handling it now, once the tax is paid, several things happen. This is kind of interesting. First of all, future lifetime RMDs are eliminated on those funds, and therefore lowering the client's future tax bills, especially if tax rates rise, which is likely. That's his opinion, that he thinks tax rates are going to rise. But the future lifetime RMDs are eliminated. And what are RMDs? For those that you don't know, it's required minimum distributions. The CARES Act also made some changes on that. Now at age 72, after that, you have to take a certain amount of funds from your IRA, a traditional IRA each year. It's a required distribution. That's why it's called required minimum distributions. The IRS sets that amount, guidelines. It's an actuarial calculation, and it's based on your age and the account value. And wherever you have your IRA invested, if you want to know what that's going to be each year, the financial institution can provide that information for you. So the amount that's taken out each year increases each year and is required. Well, this can be eliminated by using the life insurance. This is another flexibility tool. And again, that can be very important, like Ed Slott talks about here, because what are future rates going to be? What are future tax rates going to be? That's an unknowable thing. So we're going to talk about this a little further in the next segment, so stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. And hey, we're kind of tired about talking about COVID. We've been talking about that since the beginning of March. And how it affects your money and all that kind of stuff. And like I said, use some cautious optimism. There's reasons to be optimistic as states are starting to open, but there's certainly keep things with one eye open. I've read one article that said, look, if you're investing your money, it's any kind of market risk right now, do it cautiously and keep an eye open and be willing to react quickly because it's hard to say what's going to really happen. But like I said, I don't really want to talk about that a lot because a little burned out on it, as many of you I'm sure are. But it has caused some opportunities, and one of them is from the CARES Act. I'm really focusing on today, and there's a number of CARES Act provisions that have, affected the small business loans, the unemployment, and IRAs in particular. And when it comes to IRAs, in terms of how the monies are going to get distributed, the taxes on it, and then particularly to the next generation has changed dramatically. I'm referring to this article from Ed Slott, and Ed Slott is one of the top CPAs in the country. The Wall Street Journal calls him the best source of IRA advice in the country. He wrote an article recently saying why life insurance is the new stretch IRA. In other words, if you've set up if you have an IRA, 401k, any 403, any of those qualified plans, and you've set it up, done some tax planning, some estate planning, maybe set up a trust for it, or various different things that you've done. His point here is it probably will not work like you intended without a prohibitive tax cost. In other words, the stretch IRA rules have changed. And now's the time to take a look at your plan and reconsider it because, again, what you planned on, what you put in place, what Ed is pointing out here, probably isn't going to work like you intended it to. And you want to look at life insurance as a possible tool for that. In fact, he's really recommending that along with Roth conversions. Depending on your situation, one or more can be the better fit. It's worth looking at it. But the bottom line is it's worth looking at because, again, the rules have changed. And I like this point he makes here. He says, look, I don't sell life insurance or any other investments. I'm a tax advisor and have no interest other than seeing clients have effective tax planning for their retirement strategies. This is a pure CPA talking about one of the best in the country, one of the best in the business. And like I said, before you get turned off about life insurance or you don't say, oh, no, he's recommending not only he's recommending a permanent policy, not term, a whole life policy because this plan has to hold up for the long term. And like his point says, if you use the insurance tool, we're talking about a cash value insurance contract, much like I talk about with the personal bank concept in accessing funds, growing cash, having tax benefits. He's using the same tool to maximize or minimize taxes, I should say, for next generations from a tax planning standpoint for IRAs, 401ks, those kinds of accounts, okay? Like you said, he also says you can take advantage of today's lower tax rates, and he points out the current tax law is only in effect until 2026. So if you're going to redistribute this into a Roth or into a life insurance contract to enhance reduce the taxes for future generations and such, for this nest egg that you've worked hard and built, in most cases, folks have worked hard. This doesn't happen by accident, right? The problem is, in our industry, these are also known as ticking tax time bombs. I've heard the term they're tax hostile when it comes to accessing or distributions, when you're talking about traditional IRAs. So some planning needs to be involved. I always say, look, you can be proactive or reactive, on this. When you have a traditional IRA type of account, qualified account, here's the thing. You're going to pay tax when the money comes out. The taxable event occurs, whether it's now, a year from now, 10 years, or when you die. And either you have a plan or the IRS has one for you if you don't plan accordingly, right? And typically, is it better to be proactive than reactive? The answer is pretty obvious in most cases. So, again, doing nothing can create a ticking tax time bomb. You want to plan accordingly. And again, as Ed Slott is saying here, the CPA, one of the top in the business, saying, look, the plans, the way we did this for a number of years, if you've structured one of these things probably the last decade or longer, and you thought you were taken care of and you had it resolved, the CARES Act has turned it on topsy-turvy. It's basically turned all this on its ear. And like Ed Slott has said, it probably won't work like you intended it to. So take a look. Contact us at yourpersonalbank.com. We can help you figure this out, structure this accordingly, get you in front of the right CPAs, tax attorneys if we need, whoever we need to use as a strategic partner. You get the job done in the best method possible for you, okay? Now, like you said, once the tax is paid by structuring one of these, you're now not subject to the future tax rules that are, inevitably going to come. Changes are going to happen in tax rules. You basically address the tax issue. You're out of it. You're income tax free at that point, and you don't have to worry about the future tax rules. So your plan isn't subject to change like the stretch IRA plans were, and that's the point that Ed is trying to make through this article. And like you said, life insurance is also a much better asset to leave to a trust because it's more flexible and customizable for clients. The proceeds are paid after death, will become income tax free, and can follow the intent of the client without having to worry about working around the many IRA tax rules that often hamstring IRA trusts. And he's right. Those rules can be very complicated. You have to hire some very sophisticated tax planning experts, and the rules are, frequently changing. So it's one of those things that sort of seems like an ongoing kind of thing. You can get out of all that and get out of all those IRA rules. I always laugh when somebody starts working with me in the personal bank, and we start dealing with the life cash value, maximizing cash value, minimizing taxes, stuff like that. And they start asking me questions that are, frankly, qualified plan, IRA, 401k related. And I kind of laugh. I said, you're so used to that world and all the rules that, we've just breaking you free of that. It's like, I call it kind of a get out of jail free card, like a Monopoly. You just got out of the tax rule jail and you're free. Now there's some rules, don't get me wrong, but you're free from all that IRA rules, all the penalties and the age restrictions and all the things that are out there and keep changing. It seems like, well, they do change quite frequently, like the CARES Act changed the stretch IRA, for example. You're out of that whole world. You're out of tax. You broke free. You got your get out of jail free card, right? Of all those rules. And that's the thing. As I point out to people all the time, when they're doing tax planning or they're thinking about the tax impact of their accounts, and particularly the IRAs, because that's where the big tax impact usually is. What if the IRS's rules don't fit your plans? And, I find quite often with many clients that being the case. You have to be subject to those rules. And I can't tell you how many times I've had clients who are frustrated for various reasons. And how many times I've heard over the years, many, many, many times, people saying, look, if I had known this is how it really worked, I would have never done it. See, the thing is, you're deferring, like I said, you're deferring on the seed a small amount of money to then, in a traditional IRA type of setup, to then pay taxes on hopefully a much greater amount of money at a future unknown tax rate and with unknown rules, because rules keep changing. The tax rules keep changing. And it's hard to plan that way for your future when you have so many variables. And if you've got the money in a market risk situation, of course you have that variable. And when you're dealing with market-related risk variables and you're dealing with unknown tax variables, that's a lot of variables on what is frankly defined as a retirement account. I always say, what does IRA stand for? Individual retirement account. The purpose of that money, for the most part, is to supplement retirement. In other words, in most cases, you're probably going to need it, or a good portion of it. Yet there's a lot of uncertainty involved with it, and unknowables, variables. And by using the life insurance tool, like Ed Slott is talking about, you can eliminate that unknown future tax risk, those unknown rules and those unknown rates. We're going to finish up in the last segment on a few more thoughts on this, but contact us at yourpersonalbank.com for more information.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we're rounding third. We're coming in the last segment, and I just want to say we're talking a lot today about IRAs. The CARES Act, which was passed by Congress as a stimulus package for COVID, has created some changes that affect IRAs. So anyone with a traditional IRA may be affected by this. and particularly the stretch IRA provisions. And that's why Ed Slott, I've talked about this already, is one of the top CPAs in the country. The Wall Street Journal calls him the best source for IRA advice. He's written books. I've heard him speak. He's an excellent source. He's past chairman of the CPA board of New York. Again, one of the top, most credible sources I can give you. And his article he wrote recently, which we'll post on our website, yourpersonalbank.com, is why life insurance is the new stretch IRA. See, the point he's making in this article, I'm going to summarize, is real simple. The planning that's been done for the past decade or longer in terms of with IRA planning, estate planning, tax planning has changed. The rules have changed. So like he said, the thing is, the plans that you set up, if you set up a plan before, it probably won't accomplish your desired result without prohibitive tax costs. So his point is you need to relook at your plan. And I strongly recommend contact us at yourpersonalbank.com. We can share with you how to improve your situation, change your strategy, make it work like you intended, okay? Because the rules have changed. And the thing is, like he points out further in this article, by getting out of the IRA world, and we all know the qualified plan world has many, many rules, penalties, taxes, and changes in the future. You can get out. You don't have to play in that ball game. You can get out of it and eliminate your future tax risk. And what I mean by that is what is the future rate of that money going to be when you take it out? I often explain it to folks this way. It's kind of like the IRS has a lien on your IRA. They own a portion of it. The problem is right now when you do take it out at whatever point, you don't know what portion it's going to be. It's all dependent on future tax rates, your income, all those kinds of things. So it's an unknowable thing. You can eliminate that unknown. And using life insurance, as he points out, is a better tool, a more flexible tool. You can leverage it. There's a lot of things you can do to create a more less tax with a more flexible plan. And again, contact us at yourpersonalbank.com to determine how that can improve. We can improve your situation there. And if you're thinking about, if you have Ed even talks about here, even if you have a smaller IRA, this isn't necessarily for just large balance IRAs. Yet, of course, those are going to be impacted greatly by this change, this tax law change. But pretty much IRAs of any size can be impacted by this, and certainly should take a look in terms of how this money is going to be taxed for both you and your heirs. And we need to address that and look at it. And there's never been a better time because, again, the old rules don't apply anymore. And the old rules were in place for quite some time. And we have a limited amount of time to take advantage of the current rules. For example, as Ed points out in the article, the current tax law is in place till 2026. And we're going to reposition accounts to address this tax issue, to do the best tax planning. We need some time to reposition it. You typically can't move these accounts all at once, like from one to the other, boom, because you can create huge tax implications, and you don't want to do that. Don't want to pay a big tax bill. You typically have to spread it out over several years. And as Ed points out here, you want to do it when you want to take advantage of today's lower rates, because we don't know what the future rates are going to be. And a lot of people are concerned about, the Fed printing the money that they have for the stimulus stuff. What are tax rates going to be in the future? It's really hard to say. There's no way to know. So my point is, it's really worth looking at. I can't stress this strong enough that if you have an IRA, 401k, 403b, 457, any of those kinds of qualified type plans, it makes sense to look at both the process of contributing into it, but then also what's the distribution plan to minimize the tax impact for both you and your heirs. And that's really what Ed is referring to in this article. Like I said, we're going to post it on yourpersonalbank.com. Check it out, download it, pass it on. But I strongly recommend contacting us to get more information, to learn, because everybody's situation is different. And even in the article, he said, look, this isn't a solution for everybody, but it's certainly something that should be looked at. The last thing I kind of want to share here is this. I'm going to tease for next week's show a little bit. I've got some exciting information I want to share in terms of positive arbitrage on loans using traditional banks. In other words, we're going to combine the insurance industry with the banking industry and show you how to get a positive arbitrage on policy loans. I'm going to go into that quite in more detail in next week's show, but I just want you to know, stay tuned, because I'm going to encourage you. That's going to be a pretty exciting thing for us to do. But again, we're going to talk about more about solutions as we go forward, and hopefully as this whole situation settles down, and frankly kind of tired of talking about it, the COVID crisis, the financial impact. But of course now there's some opportunities and some changes, some adjustments that should be made by many people to take advantage of this situation as far as their money goes, not in a bad way, but in terms of maximizing what your money is doing going forward. So again, really encourage you contacting us at yourpersonalbank.com, because we can really share with you how this can impact you, how you can best position yourself and reduce and eliminate future tax risk, tax unknowns, tax rules. Okay. We also, of course, can reduce market risk. We have a number of tools available. I'm excited about sharing another tool that's coming up where we have potential. It's a growth type of account that can grow with unlimited upside potential with a floor. In other words, the floor is 7.5% negative to the downside, unlimited upside with a growth factor of 2.7, by the way. I'll go into more detail about this in next week's show, but we've got some exciting stuff coming up and some real awesome solutions that can really impact your money and your future. Because like I was saying in the beginning, when all this came down, I started talking about this all the way back in March. I said, look, be cautious, be careful. There's a lot of uncertainty right now, but it's going to create opportunities. And those are already coming about. And those opportunities I want to share with you so you can maximize the growth on your money, minimize the taxes on your money, and ensure that you're going to have what you need so you don't run out of money in retirement, bottom line, and have the funds available and have some certainty with that you know it'll be there while maximizing growth all at the same time. We have those financial tools available to be able to accomplish those things. So I really look forward to catching up with many of you, and I really appreciate the comments, and a lot of folks have been reaching out. It's been exciting and asking questions and becoming new clients, of course. But contact us at yourpersonalbank.com, and we'll look forward to talking to you next week.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.